Hello dear students, welcome to SV Commerce Institute. Our second chapter, recording of business transactions. We note these important notes. Voucher number 1. Vouchers are the source of the documents which are used for recording the transactions. In general, they also act as a proof of all business transactions, which includes different types of source documents like invoice, debit note, cash memo, pay in slip, etc. Vouchers are also services as legal evidence for different purposes like tax calculation and auditing of accounts. Vouchers consists of a detailed information related to a particular transaction. For example, transactions date, name of the firm, amount of transactions, etc. Preparation of vouchers. Vouchers are prepared in different forms for different types of transactions. The different vouchers which are prepared in business are as follows. First one, cash memo. Cash memo is prepared when purchase or sales goods are made for cash. Second one, purchase invoice and sales invoice. Purchase invoice is prepared when firm purchase goods on credit. It is used by the supplier of goods. Sale invoice is prepared by the firm when it sells goods on credit. Third one, next, receipt. It is issued to the customers by the supplier, retailer or wholesaler later after receiving a cash for particular purchase. It is evidence given to a customer indicating that amount is paid after purchase. Next one, pay in slip. Pay in slip is also known as deposit slip. This slip is used to deposit cash or check into the bank. Next one, check. It is an instrument which can be issued by the bank account holder or ordering the bank to pay certain sum of money to the person who is going to deposit it in the bank. Next one, debit note and credit note. Debit note is issued by the seller when the value of goods or services supplied by him is increased, or it is also used in case of purchase returns. It includes small explanation about the returning goods, that is price, discount, tax, etc. Credit note is issued by the seller when the value of goods or services supplied by him has been reduced, decreased, or revised, or it is also issued in case of sales returns. It also includes small explanation about the return goods, that is price, discount, tax, etc. Next one, accounting equations. Accounting equations is mainly used to describe the double entry system of bookkeeping. It explains the relationship between assets, liabilities, and capital bonus equity. The accounting equation can be expressed in the following manner. Number 1, assets is equal to liabilities plus capital. Next one, capital is equal to assets minus liabilities. Liabilities is equal to assets minus capital. Next one, system of accounting. The accounting system of accounting got two types. They are as follows: systems of accounting, cash system of accounting, Next, mercantile or accrual system of accounting. Figure system of accounting. So the above system. Next one, account. A account is record or statement under which all or the financial expenses and income are recorded and disclosed for the particular period of time. Account consists of three parts. Title: it describes the nature of the asset, liability or equality of the account. Second, debit side: the left side of the account is known as debit side. It is donated by debtor. Credit side: the right side of the accounting known as credit side. It is donated by the credit. Classification of types of accounts. At the time of the journaling, the transactions on the business or double entry system. Transactions are having classified into three accounting which are as follows accounts. First one, personal, natural, artificial, represented. Second one, real, tangible, intangible. Third one, nominal, expenses and losses, income and gains. Figure classification of accounts. Personal accounts includes all the transactions which are related to persons with whom the business carries out transaction. Personal accounts are further categorized into three different accounts which are as follows. Natural personal accounts. These are the accounts of human beings who are God's creation, that is, they are natural and not artificial accounts. Example, Mahesh account, Suman account, etc. Second one, artificial personal accounts. These are the accounts of the corporate bodies or institutions which are considered as a person's business. Example, the account of a club, the account of an insurance company, the account of government, etc. Third one, expense representative of personal accounts. Usually, these accounts are prepared when certain amount is due to a person or group of persons. Example, outstanding salaries account is opened when salaries are due to employees. These accounts are represents the individual or the group of individuals. Third one, rule of personal account: debit the receiver, credit the giver. Real accounts. Real accounts are those accounts which they involve the transactions relating to the properties and assets of the business. Real accounts are of two types. They are tangible asset, tangible real assets. All accounts which are related to the assets that can be measured, touched, viewed, left, felt, etc. are categorized as tangible and real accounts. Example, cash account, stock account, including building account, furniture account, etc. Bank account is not considered as a tangible real account because it is treated as an artificial person, that is regarded as a personal account. Intangible real assets. Intangible real assets involves the accounts of those whose assets can be measured in terms of money but are the abstract in nature, etc. They cannot be touched. Examples: patience account, goodwill account, etc.